In September 2008, a 158-year-old bank collapsed in less than a week.
Lehman Brothers, the fourth largest U.S. investment bank, became the biggest bankruptcy filing in history.
Not a small bank, not some unknown company, one of the biggest financial institutions on earth. Gone. Overnight, trillions of dollars vanished. Millions of people lost their homes. Millions more lost their jobs. And the terrifying part? Almost nobody saw it coming. But here's what they don't tell you in the news reports. The warning signs were there for years. Bankers saw it, a few investors saw it, and they chose to stay silent because they were making too much money to care. Today, I'm going to show you exactly how the 2008 financial crisis happened, who caused it, and more importantly, how you can make sure it never destroys your money the way it destroyed millions of others. Stay till the end, because lesson number 3 is the one most people still get wrong today.
Welcome to Global Wealth Desk. If you're new here, this channel is all about helping you understand money, markets, and investing in simple terms, no jargon, no fluff. And there's no better place to start than the biggest financial disaster of our lifetime.
Let's rewind to the early 2000s. Interest rates were low, borrowing money was cheap, and banks realized something. They could make enormous profits by giving out home loans. Lots of them. So banks started lending money to almost anyone who wanted to buy a house, even people who couldn't really afford to pay it back. These were called subprime mortgages, risky loans given to risky borrowers. But here's where it gets interesting. Banks didn't just keep these risky loans on their books. They bundled thousands of them together into complex financial products, gave them a fancy name, mortgage-backed securities, and sold them to investors all over the world, labeled as safe.
Rating agencies, the companies whose job is to warn investors about risk, stamped many of these products with top ratings. AAA, the same rating you'd give to the safest government bonds. Investors trusted those ratings. Pension funds, banks, even foreign governments bought them. Nobody wanted to ask too many questions because everyone was making money. House prices kept rising. Wall Street kept profiting. Homeowners felt richer than ever. But underneath this entire system was one dangerous assumption, that house prices would never fall. And in 2006, they started to. As home prices dropped, something terrifying happened. Millions of homeowners, the ones who were given loans they couldn't really afford, started missing payments. Foreclosures skyrocketed. Suddenly, those safe mortgage-backed securities weren't safe at all. Their value collapsed. And banks that were holding billions of dollars worth of these products started losing enormous amounts of money, almost overnight. By early 2008, cracks were turning into fractures, but most of the public still had no idea what was coming. Then came September 2008. Lehman Brothers, a 158-year-old investment bank, one of the largest financial institutions in the world, filed for bankruptcy. It remains the largest bankruptcy in U.S. history. Panic spread instantly. Banks stopped trusting each other. Credit markets froze. Stock markets around the world crashed. The Dow Jones lost over 50% of its value from its peak. Companies couldn't get loans to pay employees. Businesses shut down. Unemployment surged. Governments were forced to step in. The U.S. government approved a $700 billion bailout to try to stabilize the financial system. Central banks around the world, including in Germany and Canada, slashed interest rates and pumped money into their economies to prevent total collapse. By the time the dust settled, over 8 million Americans had lost their jobs. Millions lost their homes. Trillions of dollars in wealth had simply disappeared. So how does something like this happen? And more importantly, what can you actually learn from it to protect your own money? Here are 3 lessons that still matter today.
Lesson number 1. Debt without a safety net is dangerous. Millions of people took on mortgages they couldn't truly afford, betting that home prices would keep rising forever. When that bet failed, they had no cushion left. The lesson isn't avoid debt completely. It's this: never take on debt assuming everything will always go right. Always have a buffer. Lesson number 2. Safe investments aren't always safe. Those mortgage products were rated as safe by trusted agencies. They still collapsed. This teaches us to never blindly trust a label. Always understand what you're actually investing in, not just what it's called or how it's rated. And lesson number 3, the one most people still get wrong today: Diversification isn't just about owning different stocks, it's about not being overexposed to one type of risk altogether. In 2008, banks, investors, and even pension funds were all exposed to the same risk, the housing market, just packaged differently. It looked diversified. It wasn't. Today, many people think they're diversified just because they own 10 different stocks. But if all 10 are in the same sector or tied to the same economic risk, they're just as exposed as those investors were in 2008. Real diversification means spreading risk across different asset types, industries, and even countries.
The 2008 crisis wasn't just a story about banks and bad loans. It was a lesson about human behavior, greed, blind trust, and the danger of assuming good times will last forever. Markets will always have ups and downs, but the people who protect their wealth aren't the ones who avoid risk completely. They're the ones who understand it. If this video helped you understand the 2008 crisis better, hit subscribe. Because on Global Wealth Desk, we break down real financial history and real investing strategies every single week in simple terms anyone can understand. Drop a comment. Do you think another crisis like 2008 could happen again?
And subscribe